Hello, hello. My name is Dr. Brittany Helford, and I am your wealth coach and internal medicine physician. And today we are going to be talking about tax efficiency. Now, a little bit of a disclaimer here because I am not a CPA, nor am I a tax strategist. But as a high income earner, as a wealth coach, and married to a physician with a private practice, I have had to increase my literacy on tax efficiency because each year the IRS basically takes a lot of our money, right? And so part of building wealth is not only active generation of income, but also making sure that you're able to keep the majority of what you make. I can say honestly, when I started this whole journey to becoming a physician, to paying down my debt, and now thinking about wealth, taxes was something that just happened to me. I felt as if I had to pay them and there was really nothing that I could do. But now, as I have improved my literacy, I would say that I spend a lot more time implementing tax strategy into our financial plan because, again, I try not to work any additional hours. Like I almost never pick up an extra shift because I don't want to earn income actively and have most of the government take my money away. So I spend a lot of time putting into play our strategy here. All right, so the first thing that I want to talk about of why your financial plan needs tax efficiency is that taxes will be your biggest expense as an adult. So if you think about taxes, there are really kind of three huge buckets of taxes that we will pay. The first is taxes on the money that you earn. So that is income tax, basically. Capital gains tax is also one of those buckets. Taxes on what you buy, so our sales tax, and then taxes on what you own. The excise tax is mostly on what you own. So it could be, your property tax, your vehicle tax, all of that. So you get three major buckets of taxes, right? And so if you think about taxes, especially the one that is a little bit more visceral for us, like it has that gut wrenching feeling, is income tax. And that is taken away almost immediately before you see any input from your exchange of time and energy that the government will take income taxes. And depending on the elections that you've made, they may take less or more. And so therefore you may owe or get a refund of taxes at the end of the tax year. So you want to think about taxes because, again, anytime you're trying to generate wealth, you could think about it as far as the wealth equation or the money equation as your income minus your expenses equal your opportunities. And so if you are trying to increase that opportunity, what is left at the end of the day, then you can either increase your income through active and passive income generation or minimize your expenses. And so taxes kind of fall into that expense bucket. Before, I didn't consider tax as an expense. When you're budgeting, right, and you're reviewing your expenses, then there are things that are fixed and there are things that are variable. But even in considering both fixed and variable, there's a lot of personal control that we can exert over our expenses. So a variable expense, your grocery budget. If you don't buy organic food, then that's going to decrease the grocery budget. And we all know that right now, inflation, like the cost of eggs and milk and bread, is more expensive. So you need to start to shift your mindset and your thinking about taxes as an expense that you also can exert some level of control over. Alrighty, moving on to the second tenet of why tax efficiency should be part of your plan is that taxes and tax law changes, okay? So you want to create a financial strategy that can weather the storm, that can evolve as tax law evolves. And so if you're thinking about, okay, what do I need to do today now for my taxes, and not having a perspective that allows you to think 10 years, 20 years into retirement, then your myopic view may limit the amount of wealth that you can have at that time of retirement and throughout the longevity of your lifespan. And that is because tax law changes. And unfortunately, unless you're like sitting with the IRS or with the president, then we actually may not have much control over the changes that will be implemented at the time of retirement or later on in life. And so it's important that you start to think about, how can I make my tax strategy most efficient today tomorrow, 10 years down the road. And how you do that is by implementing diversification in your tax strategy. So if you are a high income earner and you have been able to max out your retirement accounts each year, then there's additional opportunity this year for you to put away more money, more pre-tax dollars into that bucket in the forms of 401ks, 457bs, IRAs. Specifically in Roth IRAs, they've increased, which is an after-tax account, they've increased the amounts to $6,500 that you can contribute in 2024. For the 401ks and the 457bs, now you can put away an additional $2,000 into that account. So that's another way to offload some of that tax burden, because that $2,000 is not going to be taxed, right? That additional $500 is going to be taxed today, but is not going to be taxed when you pull it out in retirement. So when you're thinking about how to make your tax strategy, your financial plan tax efficient, then you have to put up multiple layers of defense and make sure that you've accounted for potential changes within the tax law that might impact your wealth generation. Number 3, the reason why you need tax efficiency in your financial plan is because you are going to evolve financially. This is really exciting, right? This is really exciting that we all go on these journeys. Sometimes I think that we like to kind of give ourselves an identity or adopt like a fixed mindset that where we are today, we are always going to be. And I want to give you permission right now to allow yourself to grow, allow yourself to make mistakes. And this is really important when you're thinking about your financial plan and your financial journey, and to set yourself up today for growth. One of the budgeting mistakes is that oftentimes we create a budget that is fixed in aspiration and not in truth. And I would say that that's probably the opposite for our tax strategy. And maybe that most of us don't even have a tax strategy, because I didn't, right? But if you're creating a tax strategy, you may be doing the opposite here. You may be creating a tax strategy that is founded in truth, in actuality, in current state, in today, and not in aspiration. So when I started out my financial journey, I mean, maybe we can just go all the way back to Flint, but I wasn't paying any taxes because I didn't have any money. But when I graduated from residency, right, I had all of this debt, and now I'm a high income earner. There were 2 truths. I had a lot of debt, I had a high income. So now I've paid down that debt, the student loan debt. I've acquired a new debt because we purchased a condo here in Boston. Now I have different debt, but I've paid down that debt, and now I have a much larger net worth than I did when I started out in my financial journey. And so if I think that I am going to be right here today in the same state in retirement and not aspire to have more passive income, not aspire to have multiple streams of passive income, to have multiple streams of wealth, to have investments, then I would be creating a tax strategy that is to the detriment of where I want to be or where I could be. And so I think it's really important that when you're thinking about your tax strategy, you have to give yourself permission to evolve. And you have to say, well, right now, my net worth may be negative because I've been there, right? But at some point, I'm going to have a lot more money. Like, I'm going to be in this area in which I'm going to be a higher tax earner. And so what do I do today to set myself up for success when I accomplish that vision, when I accomplish that better self? And this is really important. I'm going to give you an example. When I was in residency, I invested in a 401k instead of a Roth IRA. And if you know anything about the differences between 401ks and Roth IRAs, basically one of the biggest differences is that a 401k defers taxes and a Roth IRA doesn't. Okay, so that means if any money that I generate as a resident, I'm not paying taxes on the amount that I put into the 401k, versus I will be taxed on the money that I put into a Roth IRA. Now, this is imperative to think about because as a resident physician, I only earned $60,000. If you think about there are marginal tax brackets, then it's important to me in keeping most of my money and thinking about tax efficiency down the road, that contribution that I made to the 401k as a resident physician did not actually offload my tax burden significantly because I was only making $60,000 at that time versus the amount of money that I pull out in retirement because my net worth is growing. The amount of income that I'm going to have to pull out to support the lifestyle that I desire in retirement is going to be much higher than $60,000, and therefore I'm going to basically lose more of my money in retirement because I put the money away as a resident. Instead, if I had paid taxes on that money as a resident in the lower tax bracket, put that money into a Roth IRA at the time of retirement, I would not have to pay taxes on that money, and therefore it would have allowed for much more growth and retention of wealth. And I think oftentimes, if you forget about the stage in which you are today and you fail to incorporate where you're going to be in retirement, then you're going to make the wrong strategy, the wrong decision for tax efficiency today and tomorrow. And so it is critical that we incorporate this into our strategic planning. And I would say that majority of us fail to do this. So moving on to the last reason why you need to start to think about tax efficiency in your financial plan is that most often the strategy is absent from your financial plan and no one else is going to think about it if you don't. And the reason why I say that is because oftentimes we come to this point in which we know if we have a business, so like I said, my husband has a private practice, I have my wealth coaching business, this is generating 1099 income. And if I'm not appropriately estimating my quarterly taxes and paying in, right, then I'm going to have a larger tax bill. And so when I give that information to our CPA, a tax accountant, they're going to do all the calculations and they're going to say, okay, this is how much is owed or this is how much you'll get as a refund. But they are not thinking about what are the ways in which Brittany can optimize her taxable accounts. And I can say this with certainty because I've had CPAs in which I read on the IRS website and say, hey, why am I not doing this? And why did you not share this with me? That this was an opportunity in which I could retain more of my wealth. It's because oftentimes when you go to a CPA at the time of taxes, their sole focus is to put the numbers in, to do the taxes, and to give you an output that says how much you need to pay in or how much you will get back. They are not strategizing about how you can retain wealth and how you can build wealth through effective tax strategy. So you have to start to think about this unless you're going to hire a tax strategist in which, depending on where you are in your financial journey, depending on where you are as far as your income, it might be time for you to start incorporating tax strategists into your financial community. And so this is something that I do with my clients because I know that on all levels there are ways in which we can find loopholes sometimes or opportunities for us to maximize our tax strategy and to retain more of our money. This is imperative. And it's also important that you start to think about this in January, right? Because I have been in the situation in which in October, I'm trying to implement a tax strategy, and unfortunately, there are only 2 more months left to the year. So this can be time bound. And if you don't have the opportunities to implement the strategies to work to figure it out, then you're not going to be able to optimize your year for that tax year. So it is important that you start to think about this right now today. How can I optimize my tax strategy? And this is something that I work with my clients. Basically, I say, I'm not a CPA, I'm not a tax accountant, but whatever I've learned to work for me, then I give also to my clients. And when you are maximizing your tax strategy, you have to have really good record keeping because a poor input is just going to generate a poor output. So oftentimes before, I had better bookkeeping and thoughts about how to implement a tax strategy, we would be absolutely upset with the output of how much we had to pay. I realized that, really, this has nothing to do with the accountant. This has everything to do with me and my behaviors, my record keeping, and how much I know to implement these tax strategies throughout the year so that I could give my accountant the best records, the most updated numbers of expenses and everything to incorporate into that calculation to produce a more favorable output, too often we just fail to do that. If you give me trash, you're gonna get out trash. I mean, there's no way you're gonna make a gourmet meal out of just like trash, scraps, rotten food. It's impossible, right? But we expect that our tax accountants can do miracles when we actually had no strategy involved. So this is the reason why it is so imperative that you start to think about tax efficiency, not today, not just tomorrow, but 10, 20, 30 years down the road. And you continue to revisit your tax strategy and your financial plan, because as you earn more money, as you evolve in your financial journey, then that tax strategy also has to evolve. Right now, we're thinking about how to purchase a rental property, and that's one of our goals for this year. And so I need to think about that, like from a tax perspective, what are the implications? How is this going to help us? How is this going to hurt us? And to understand that, okay, well, this is going to be a form of passive income. Passive income can only offset other passive income in your tax strategy. So then what other forms of passive income are now gaining money, capital gains, right, and investments that can be offset by the purchase of this real estate property and depreciation? But that requires you to have that foresight, because we all think that, okay, short-term rentals is this shiny new thing, and you may have a tax burden at the end of that. So it's really important that you start to incorporate tax strategy throughout everything. All right, so that is all. I appreciate everyone for listening today. And if you are a woman who are looking to maximize your finances, from mindset to management of your money, the day-to-day, and to start to incorporate strategies so that you can have a better output, then I want you to DM me. Right now, I am enrolling clients into my group coaching program, The Joyous Journey to Wealth, and I would love to help you to not only create a strategy for today, but to gain the financial knowledge so that you can continue to create strategies that are going to work for you as you evolve in your financial journey. Let's get the conversation going. Let's set up a call so that we can figure out if my group coaching program or working with me in another capacity is the right money move. All right, have a beautiful, beautiful week. Thank you for tuning in.